Football's done. Baseball's locked out. You're not locked out here. This is the IssuesWatch podcast. Hello, and welcome to the IssuesWatch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm the partner in charge of accounting and auditing at Sobel & Company. These A&A episodes now qualify for nano credits. If you're interested in earning CPE credit for this or other episodes, hit the pause button and go over to njcpa.org/nano to find out how. As a quick disclaimer, these views and statements expressed herein are my own and not necessarily those of the NJCPA or Sobel & Company. Okay, so what do we have going on? We have a few things. The SEC was pretty big this time, not the basketball. I know March Madness will be coming up soon, depending upon when you watch this, but the SEC itself, and we'll talk about that towards the end. So the FASB had a recent board meeting earlier in the month, and they covered three particular areas, kind of all related. Now, before I just mention those areas, and there's a loose reference to it, I want to circle back to a topic called CECL. Current expected credit losses. If you haven't been looking into this, I strongly recommend that you look into this. The pronouncement, which was delayed during COVID, is going to be effective next year, much like leases, which we'll talk about later on. Just as a reminder, it's going to be effective and it's going to have a significant change as it relates to the potential for credit losses. Now, some people think, I don't have loans, I don't have this. If you have receivables, you have to consider this. That's the way this stands now. You know, I'm hoping something like this changes, but I've attended a few seminars on this, and I leave each session more confused than the previous time. I didn't think it could get that bad. But anyway, so at the board's recent meeting, they discussed the codification improvements on credit losses, which isn't effective yet, but they're doing codification improvements. But some people have adopted it. Talked about troubled debt restructuring and credit losses on acquired assets. So if you have any of these, I strongly recommend you look to their past meeting. They did ratify certain decisions. To the AICPA issued a technical question and answer, section 6400.71, relating to healthcare entities. And I was wondering when they were going to address something like this, because what this focuses on is, should healthcare entities that receive items free of charge to dispense to specific patients recognize the fair value of the items received? So you knew with all this COVID stuff that was going on, the pandemic issues, and then people receiving vaccines or other treatment medication free of charge from providers, should they recognize the fair value of that? Now, I don't know what falls under healthcare entities. When I looked at the TQA, it didn't give a real clear example. It talked about for-profit, non-for-profit. But are they just talking about hospitals? Are they talking about clinics? Are they talking about large medical practices themselves? If you do handle any of these, I strongly recommend you look into it. If you have entities that fall into this category and have received this type of medicine or care to be able to provide, it may fall under 606, the revenue recognition, revenue contract with customers, and 958, which is actually nonprofit accounting. So I recommend you look into that. The AICPA issued an exposure draft to amend the standards relating to compliance audits. They found that some of the wording was not jiving with some other areas, and they're aligning the AUC 935, the compliance audits, which recently issued SASs. Remember, if there's been a suite of SASs from 134 to 145, came out over the past couple of years, and because of COVID, they delayed some of the effective dates. Well, now that's, COVID's kind of, I don't want to say going away, but the effects of it and everybody's trying to get back to normal, things are starting to become effective. So watch for this, because they're trying to align a lot of things. The AICPA clarified the peer review standards. Now, this should not have a significant effect, and the peer review board feels this should not have a significant effect. This is really more of a cleanup of the standards. Remember when they clarified the auditing standards? They actually try and clean things up and align it and make it more understandable and more able to read it. Some of the areas that they did focus on is the remote audits, surprise exams, which is good because you don't have to have a surprise exam in a systems review now. You can have one, but you don't have to. Depending upon your risk assessment, you can still have one. And eliminate the term significant deficiencies. Now, what's important is this is for reviews commencing on or after May 1st, 2022. So that's two months away, 2.5 months away, if I do my math right. Okay, and you can't, early implementation is not permitted. Now, I don't know many people that are starting peer reviews before May 1st, or April 15th, although I do know the AICPA has a lot of meetings that happen during busy season, because not everybody does tax. Sorry, Nicole, but it's true. On to the SEC. We had a bunch of information that came out from the SEC. I'm not going to go into in great detail, but I strongly recommend you look it up if you deal not just in SEC, because some of this is not public company related. Some of this actually relates to private equity funds and investment advisors. Now, we know a lot of private equity funds are not registered with the SEC, but for some reason the SEC and the SEC chair that's out there, Gensler, is really focusing on these. He's felt that they've been pretty much like a closed group that have isolated themselves or insulated themselves from the requirements. And there's a proposed rule change, 341 pages in the release. It creates new requirements on fund audits, focuses on the books and records, and advisor-led secondary transitions. Now, I don't deal particularly a lot in this area. I have broker-dealer clients and some hedge fund clients, but not a ton in this area, so I don't see a bunch of this. But if you do have this, not that if you're handling SEC work, but I strongly recommend you look into this because it could have a significant effect. It also addresses changes for preferential treatment to certain investors. You know that there's some advisors, some plans that give some, not inside information, but advance investment ability into some of the funds. And if you do provide preferential treatment, that has to be disclosed. So they're looking for a lot more transparency. Talk about indemnification, fees, and the documentation of compliance policies and procedures. So it's big. If that wasn't enough for you to try and digest, they came out with a proposed rule relating to cyber risk management for investment advisors. So the previous one was 341 pages. This is another 243 pages. Cyber risk is enormous. We do some broker-dealer work and 111K, and we've gone through a PCOB examination, and they ask about cyber risk. It is a big area. If you're not focusing on that with your clients at every level, I'm not saying that you're doing the cyber risk itself unless you're a qualified person in that area. You should be talking with your clients about cyber risk. SEC also came out with a proposed rule change on shortening the settlement cycle. So this also relates to the investment community. And if you haven't had enough to read and you're bored and you don't have enough tax stuff going on, this is another 247 pages to read. So add that all up. I can't do it that quick because I don't have my calculator, but you're talking around 600 pages of proposed rule changes. It's a lot, but if you deal in that community, I strongly recommend that you look into that information. Okay, and so on some wrap-up items, we want to remind you of the lease standard, that it's effective for calendar year companies, Jan 1, 22. If you have not started focusing on this, please do it yourself, your company a favor, and start looking into this lease standard, okay? If you have questions, give me a call. I'll give you some, not scare tactics, but some information on what you need to start doing. The first thing is get a listing of all your leases and agreements that potentially have embedded leases. Accounting for ERC and accounting for PPP, that's a hot topic right now. If you or you have clients that received ERC, employee retention credits, or PPP, or other government funding, not talking nonprofit, please look into what the accounting treatment's supposed to be for this. You know that they're going to be jumping all over this. And in our last presentation, I don't know if you've had a chance to view it. If not, go back and look at that one. I talked about bait also. That's a particular hot topic right there. So with that, in closing, I'd like to look ahead to spring and highlight a couple upcoming in-person A&A events. On April 26th, the Bergen chapter will be holding a 4-hour A&A update at the Knights of Columbus in Westwood. And on April 29th, the Southwest chapter, these guys are all crazy, I'm happy for them, will be holding a 4-hour A&A update at the Riverton Country Club in Cinnaminson. And please be sure to join me and many of our fellow members in Atlantic City for the NJCPA Convention and Expo on June 14th to the 17th. Register for these and other events at njcpa.org/events. And as always, I recommend you join the NJCPA Accounting and Auditing Standards Interest Group by going to njcpa.org/groups. Thank you for joining us.